आज ना I'll show you something really interesting. Back in March 2024, retail traders used to own only 10% of the market. But today, these numbers have changed and they are actually different in different countries. There are many reasons for this regulations, taxation, data, infrastructure, and many other factors. But if we hold only this much part, then who holds the rest? Today, let's see the different players in the market. So, the most basic classification you will see on the internet is retail, HNIs, and institutions. But this is not complete. What's really important is to understand how each one of them works and what is their role in the market. So, let's see the whole picture. In the market, broadly, we can say that there are six types of players. And let's start with most relatable group, individual investors. First one is retail traders like you, me, who trade from their devices through some broker for their personal account. We can trade in stocks, crypto, forex, mutual funds, and ETFs. In this big world of finance, retail traders are often the laughing stock. They trade based on what they have learned from other retail trader about how to trade like a retailer. That's why most retail trading revolves around technical patterns, news headlines, and market hype. Individually, a single trader barely moves the market. But when millions of traders think and act in the same way, their collective panic or excitement becomes visible in price action. They might not control the market, but they are the ones who create the volatility for which institutions are already ready. And the next ones are high net worth individuals or HNIs. These are the people who already have money. We are talking like more than $1 million in liquid assets. HNIs usually have access to private bankers, wealthy advisors, and opportunities that the average investors never even heard about. Things like pre IPO investment, private equity funds, structured products, and exclusive portfolio strategies. Their approach is more strategic than emotional. And because they operate with large capital, they can create a noticeable price impact in the market. And the next comes a new age category, the individual algo traders. They are coders, quants, and tech driven traders, people who blend finance with programming. Instead of emotions, they rely on logic and algorithms. They write codes that decides when to enter and when to exit, and sometimes even how much to trade, all automatically. Their strength isn't in huge capital, it's speed, precision, and consistency. And while they might not move the market alone, they represent the future of individual trading. Now, let's talk about the next category, who keeps the economy and markets stable, the institutional investors. Let's start with the most familiar institutional player, the mutual funds like BlackRock, Vanguard, SBI mutual funds, and many others. These are the giants that manage money on behalf of millions of investors. Small amounts from many people pool together to create massive market influence. Their goal is simple, generate steady returns while keeping the risk in check. They mostly invest in public stocks and bonds. Every buy or sell they make is backed by deep fundamental research, financial modeling, and macroeconomic outlooks. The analysts working inside these funds are not just looking at random chart patterns. They look at earnings report, management commentary, and industry cycles and valuation models. Capital wise, they are huge. Even a small mutual fund manages hundreds of crores. And the big ones, they easily control billions of dollars in assets. Because of that size, their trading isn't instant. When a mutual fund decides to accumulate in a stock, it doesn't happen in a one go. They buy it slowly over days, weeks, or sometimes months to avoid moving the price too much. So, while retailers create a short term noise, mutual funds create long term direction. They are the reason why a stock quietly trends upward for months. Mutual funds are like a long term investors playing by the rules. Then next one comes hedge funds. They are the rule benders of the market. Companies like D. Shaw, Elliott, Man Group, AQR Capital, and many others. They don't just buy and hold. They short, they leverage, they arbitrage, and they often bet against the crowd. Their goal isn't just steady returns, it's absolute returns, no matter whether the market goes up or down. Inside hedge fund, you will find a team of quantitative researchers, traders, and data scientists using advanced models to find tiny inefficiencies in price. Capital wise, they handle hundreds of millions to billions of dollars, which is the pool of money of wealthy individuals managed by really smart people. They charge annual management fees as a percentage of assets under management while generating returns for the investors through capital appreciation and dividend or interest income from their investment portfolios. And now stepping into the world of investment banks. They are not your everyday banks where you open your saving accounts. They are the architects of the global finance, the ones behind every IPO, merger, or billion-dollar bond deal. When a startups become a unicorn and wants to go public, it's the investment bank that writes its IPO, decides the price, and ensures those shares find their way into the right portfolios. They also advise large corporations on mergers and acquisitions and reconstructing, helping giants either join forces or outsmart competition. They generate revenue through advisory fees and writing commissions, but they also have a separate asset management team to manage their assets. But this is not the IB's main business model. And then the next one comes pension funds. Pension funds exist for only one simple reason but powerful purpose to ensure that when people stop working, their money doesn't. Every month, employees and employers contribute to these funds. That money doesn't just sit idle, it's invested into stocks, bonds, real estate, and infrastructure projects that slowly but steadily grow over time. Their goal is stability, sustainability, and security. They are not trying to beat the market every quarter. They are trying to make sure someone's retirement check arrives every month for the next 30 years. With trillions of dollars under the management globally, pension funds are among the largest and most influential investors on the planet. They quietly move market when they reallocate assets, buying when everyone else panics, and holding when others chase movements. They are the anchor investors, the ones who provide balance and depth to global financial systems. In the world obsessed with speed, pension funds remind us that wealth isn't built overnight, it's built to the last a lifetime. And the next up, we have another quiet but powerful force, the insurance companies. They might sound boring, but in reality, they are some of the biggest investors in the world. Every time someone buys a life insurance policy, health cover, or vehicle insurance, they invest it. The company collects premium, and instead of letting that money sit idle, they invest it. Now imagine this happening at a scale. Millions of people, billions in premiums. That's a massive pool of capital that needs to be managed efficiently. Insurance companies primarily invest in bonds, blue chip stocks, and government securities. These assets are stable and provide predictable returns. Their investment style is conservative. They can't afford big drawdowns because the future claims depend on how well their portfolios perform. But their sheer size gives them incredible influence. When a insurance company reallocates its portfolio, it can shift demand across entire sectors or even move bond yields. So, while traders focus on price charts, insurance funds quietly decide where the money flows behind the scenes. In a way, they are the risk managers of the economy. They ensure lives, product businesses, and through their investments, they keep the entire financial system liquid and stable. Finally, let's talk about the sovereign wealth funds, the ultimate whales in the financial oceans. These funds aren't owned by individuals or companies, they are owned by entire countries. When nations like Norway, Singapore, UAE, or Saudi earn surplus money through oil, trade, or exports, they don't just stash it away. They invest it through sovereign wealth funds to grow national wealth for future generations. These funds manage hundreds of billions, sometimes even trillions of dollars, investing globally in stocks, bonds, real estate, infrastructure, tech startups, and even foreign governments. Their goal isn't quick profits, it's economic stability and generational growth. They help countries diversify their wealth beyond natural resources or exports. So even if oil prices crash or trades slow down, the nation's wealth keep working. Now comes the craziest category, the place where some of the smartest minds on the planet work. Here, the time isn't measured in minutes or hours, it's measured in microseconds and nanoseconds. From quant researchers to system architects, this world is built on math, speed, and precision. Every time you buy or sell, there is someone on the other side, right? That someone is market maker who keeps the market alive, meaning they continuously quote both buy and sell prices for thousands of instruments, ensuring smooth execution and tight spreads. Let me tell you a fact that don't pay the transaction costs like you and me. In fact, in many cases, exchanges pay them through what's called the rebate system because they provide liquidity in the market. Now comes the extreme layer of the market, high frequency trading firms or HFTs. This is not just about algorithms, it's about infrastructure, physics, and raw speed. Here, even a 1 millisecond delay can decide whether you make or lose millions. To achieve this kind of speed, these firms invest some hundreds of millions of dollars in infrastructure. We are talking about custom built data centers optimized for low latency. And these firms even pay millions just to get a direct cable line between the exchanges like New York and Chicago, only to save a few microseconds. Their offices look more like a tech labs than trading floors. filled with powerful servers, and they use and build the chips called FPGAs with a team of engineers and coders working to make things just a little faster. Now let's talk about prop trading firms. These are the places where traders don't trade clients' money. They trade with their firm's own capital. That means if they win, the firm wins. If they lose, the firm takes the hit. So every trade here is about performance. Prop firms hire some of the best traders, quants, and coders and give them huge buying power to trade stocks, futures, options, or even crypto. They focus on short term opportunities, market inefficiencies, arbitrage, or high speed trading. Their goal isn't to invest for years, it's to make consistent profits every single day. Most of these firms have tight risk controls, real time monitoring, and automated systems to cut off a trader the second losers go beyond limits. And because they use their own money, they have more flexible and aggressive taking trades that big institutions might avoid due to rules or client restrictions. In short, prop trading firms are like the F1 teams of the trading. Another thing to be noted here is that many of the same companies operate in all three roles we have just talked about: market making, HFTs, and prop giants like Jane Street, HRT, Citadel, Optiver, and the next ones are brokers. They are the middlemen of the market. They connect the traders to the exchanges. Every time you buy or sell some stock, crypto, or future, your order likely passes through a broker. They earn through commissions, spreads, or fees per trade. For example, like Zerodha, Interactive Brokers, Robinhood, Grow, etc. etc. And the next one is dark pools. Dark pools are the private trading venues where institutional investors like mutual funds, hedge funds, and pension funds we have discussed just before trade away from the public exchanges so that they don't affect the prices a lot. The next category is company insiders and large shareholders. This category isn't really needed to understand day to day trading, but I have added this so that you don't fall for media traps or hyped headlines. For example, there was recently a news that Larry Ellison, the CEO of Oracle, became the richest person in the world, crossing even Elon Musk. It just happened because Oracle's stock price spiked, and since he owns a massive portion of it, his net worth on paper shot up. These are the people who sit closest to the company's heartbeat: founders, promoters, top executives, board members, and large shareholders. They don't just own the company, they influence it. Their decisions about strategy, expansion, or even a single statement in an interview can move stock prices overnight. VCs and private equity firms. They enter early, invest heavily, and often exit during IPOs or at higher valuations. Their selling pressure can impact prices, especially during lock in and expiry periods. I have just added this section because it is really important to understand why this biggest pump and dumps caused. The next category is regulators and market infrastructure. Now, behind all the chaos, algorithms, and price moves, there are a few players who don't trade at all, but they still control how the entire market works. These are the regulators and market infrastructure providers. Basically, the people who make sure the game is fair, transparent, and running smoothly. In India, you have SEBI, and in US, there is SEC. Their job is to protect investors, prevent scams, and ensure companies play by the rules. They decide who can trade, what can be listed, and how insider information must be disclosed. So, if someone tries to manipulate prices or leak data, they step in. You remember the case of the Jane Street manipulating in the Indian market, right? So this is why they are important. And then the next comes the exchanges like NSE, BSE, NASDAQ, clearing house corporation. Behind them, they handle order matching, settlement, and data flow. And of course, depositories like CDSL or NSDL, which actually holds your shares in digital form. And the last category is service providers and support ecosystem like credit rating agencies like S&P, Moody's and Finch. They access how risky companies or countries are, influencing bond yields and investor confidence. Then financial media and analysts, they shape public perception, drive sentiment and can sometimes move market just with headlines. And then comes technology and data providers. They supply the pipes, data feeds, and infrastructure that trades and exchanges demand on every milliseconds. And then is the legal and compliance firms. They ensure the system stays within the rules, managing audits, reporting, and regulatory risk. So now you have seen the entire market ecosystem, how each player works. But here's the most important part, learn to understand, don't just follow. Most of those so called secret strategies, guaranteed profit setups you see online are just content, not an actual edge. So, the next time someone tries to sell you something, remember there are no secrets in the market, only understanding. And if you have made this far, make sure to hit that like button and subscribe because we will keep bringing more real research backed finance content